Hello, everyone. My name is Philip Palumbo, host of the Palumbo Pulse podcast, where we interview some of the most successful portfolio managers, economists, and market strategists to get their perspectives and views on their specific specialty. Today, we have with us Marc Weiss of Untitled Capital, who's been managing money for over 17 years in emerging technologies. So, Marc, thanks for coming. Thanks for having us today. Appreciate it.
Thanks for having me.
All right, pleasure. So, Marc, so let's start off with tell me about your firm and what you specialize in specifically.
Well, our firm was founded on the idea of only investing in emerging technology companies because we feel that's where the money is. The new companies unseat the old ones. And you can see this over time when you look at the top 10 market cap companies by decade. If you go back to 1980, IBM was the most valuable company in the world. Eastman Kodak was number 10. AT&T was on that top 10 list. And as you go through time, you can see, in 2000, Microsoft makes it there for the first time. They stay. Cisco's there, Intel's there, and then when you look in 2010, Cisco and Intel are no longer in the top 10. Walmart was in the top 10 in the year 2000. There, I think they were number 5. Amazon was only 3 years old and hadn't disrupted them yet. And so, so now when you look at the world, you have cloud, mobile, social companies dominating the top 10. And what we're trying to do at our firm is to invest in the companies that will be in the top 10 in 2030.
So, Marc, so why do you think there is always this shift, right? So in 1980, there was IBM was at the top of the list, AT&T was there. You fast forward 20, 30, 40, 50 years later, right? Things will change to where it was back in 1980. Why do you think you see that shift? Why does that happen?
Well, I think it's, I would call it big company disease. Large company, when companies become very large, they lose that innovative drive that they used to have when they were smaller, and they become very good at what they currently do. But then there's some natural limits to how big they can get there. So today it's Apple's an amazing company, but everyone pretty much has a smartphone, and there's a lot of hope that they'll be doing something with augmented reality and come out with augmented reality glasses next. But we have to be realistic. When those things come out, till that becomes 10% of their revenue is going to take many, many, many years. And so investors really have to consider if it's a $2 trillion valuation, how many more trillions of value can they add by adding augmented reality? Perhaps they can get to 4 trillion, but then you might be talking a double in the stock over 10 years, not very exciting. So what you really want to try to do is find pure play companies that ride the new trends and which will put them up into the top 10. So, when Google came public in 2004, it was a very modest market cap, in the tens of billions of dollars, but now it's in the trillions. Because when they came out, they were the new kid on the block, focused on a new style of doing search, and now they're dominant. And if you look at Google and Facebook together, they're close to 70% of the online advertising market. How much more drops of water can they squeeze from that sponge?
Right.
Not so much. So these companies then become very, very large. They've saturated their markets, and then they try to enter new markets. And so you see that with Google trying to do things like Waymo. But I think most people look at Tesla's effort in self-driving cars and they say, well, Tesla made the car, they made the batteries, and they seem to be going down that path better than Google and Waymo. So one of the things they try to expand, but it's hard for them to have the entrepreneurial spirit in those newer divisions because they're big, complex corporations, and they just they don't have the same focus and agility of startups. And this is why the venture capital industry exists. If very large size and large R&D budgets was the key to success, IBM would still be on top. There wouldn't be a Microsoft, there wouldn't be a Google, but we find that that's not the case. And that's why we have a thriving venture capital industry in the United States. And they're always producing these new companies that are very focused on these new trends. And we find that buying those companies, both privately and when they go public, is the best way to make money in tech.
So Mark, there's thousands of companies out there, right? And there was a shift in 1980, like you said, then 1990, then 2000, then 2010, and now 2020. So how do you figure out what that shift's going to look like 10 years from now, 20 years from now? How do we find that next Amazon, that next Google? From your experience and your knowledge, how do you find that?
Well, it's first, you got to start a little bit from a top down, and then you also got to do a bottom up. And so I would say from a top down perspective, it's really not so hard. It's just watch what the big companies are actually doing. Microsoft, Facebook, it was Facebook. They changed their name to Meta, Google, Microsoft. They're all investing in augmented reality. And why? Because with augmented reality, not only by having these glasses that let you look at the world with 3D images overlaid on it, first of all, that's a better way to just live life. Instead of always looking at your phone hunched over, you can now walk through the world and see the world with enhancements. So it's great for the user, but these companies want to do it because of the eye tracking. They can actually see where you're looking, and that gives you a whole extra layer of information about the person versus what they click on and what apps they use. So they're all investing in it. They're almost all of them are investing in quantum computing. They all have some investments going on in autonomous vehicles, electric vehicles. So you pretty much you could see where the big trends are. You see the big companies investing in them. But our bet is that because they're big companies, they're slow to move, they don't have that innovative drive as great as the smaller companies, that then we start looking for pure play private companies on these trends. And that's where the bottom up comes. That's when you have to go out and you hunt. And so you don't have to, if you want to say invest in the next big megatrends, which we are considered to be general AI, robotics, genomic proteomic engineering, autonomous vehicles, electric vehicles, augmented reality, quantum computing. There's the companies that are doing very deep tech, concentrated work in these areas. There's really not that many of them. Of the 1,000 unicorns that are out there, there's not many of them that say are in quantum computing or genetic engineering. A lot of them are good SaaS companies. A lot of them are going to turn out to be bad SaaS companies. We have 1,000 unicorns out there. Not all 1,000 of them are going to go public and go up 10, 20x. There's going to be a filtering there. And I think within those, we're going to see some really good IPOs that we're waiting for. But in many ways, SaaS is that's a play on cloud computing, and that's a little bit of the old trend. Of the three big old mega trends, we pretty much did it. Social's pretty saturated, right? Mobile computing's pretty saturated. Cloud computing still's got a way to go. We're not yet even at the halfway point where most applications are in the cloud. And a lot of these cloud computing companies are adding machine learning and AI, which we think helps broaden their market. So I think there's going to be a lot of opportunity there. But in terms of these newer areas like quantum computing, there's just not a great quantity of great new quantum compute companies. So you can get your arms around that area relatively quickly by looking at the 10 or so companies in the area. A couple of them are already public. You have IonQ's public, Rigetti's public, D-Wave is I think going to get eventually de-SPAC, and then there's 5, 6, or probably getting closer to 10 now. Private companies in the area, and naturally IBM and Google and Microsoft and Amazon all have quantum compute programs, but our bet is they're not going to win. it's going to be the startups that are more focused and have attracted the entrepreneurial engineers that will put in the 100-hour weeks to make it happen.
So Mark, so I understand it, right? So top down and bottom up, right? Two processes. Top down is, let's look at the large companies that are just so large, but they're making investments in certain areas that's a small percentage of their overall revenue, but they know that's the future. So that's how you identify like augmented reality. That's an example you just gave.
Yes.
You feel based on what large companies are doing that the future of augmented reality is real. Okay, so got it. The second part to that is that the bottom up is, okay, where the pure plays that will really succeed, that could be the next, can be the next Amazon in terms of price appreciation and dominance. It's just one example of what you're talking about. Do I have that right?
Yes, exactly.
Okay, great. And then from there, you believe quantum computing is another. So give me your top 3 areas that you think will be dominating over the next 10 years. Do you believe augmented reality is number 1?
No, I actually, I don't believe that one's number 1. I think it's, what we do believe is that augmented reality will be to mobile computing, while mobile computing is to PC computing. Sorry, I got to stop my phone. Apologies. So we think it's going to be very big. But what we think will be bigger is general AI. If you really solve the AI problem to get human level intelligence, that will affect every vertical in the economy, and it will enable a robotics industry that's on this at the same size of the auto industry, if not a multiple larger. So we think general AI can be probably bigger than augmented reality, even though we think augmented reality will be larger than the current smartphone market. So it's extremely large. And quantum computing possibly could be at the same order of magnitude of general AI. Sorry, go ahead.
Yeah, it's okay. Can you explain quantum computing?
Well, quantum computing is it's a way of doing compute based on something called qubits. And so it's not, and qubits can have multiple states. So it's not just a 1 or a 0 like it is with transistors, which is what we use on current computer chips. And one of the unique characteristics of a quantum computer is for each additional qubit you add, you double the compute power. So if you think about it today, let's say TSMC is at a certain current valuation, or a current, say, geometry of, say it's at 5 nanometer, and they move to 3 nanometer in terms of the lithography size, you'll double the number of chips on a wafer, or on a number of transistors on a wafer or a chip.
Right.
But in a quantum computer, if you, let's say you went from a 100 qubit machine to a 200 qubit machine, the 200 qubit machine would have 2 to the power of 100 more compute power.
Wow.
So the compute power just expands exponentially. And one of the particular, this is what I thought was a kind of a shocking revelation. I was listening to one of these podcasts from a founder of PsiQuantum with Harvard Business Review. And what he said was, if you could take every atom of silicon on planet Earth and turn it into some giant supercomputer, and then you had another 200 years of Moore's Law working for you, which isn't going to happen because we probably maybe have 10 years left of Moore's Law before that ends. 100 logical qubit quantum computer will have trillions of times more compute power than that theoretical supercomputer based on transistors. That's how powerful a quantum computer is. And when you have that much compute power, you can solve Schrodinger's equations, and Schrodinger's equations will describe precisely how molecules behave. So today we know like this enzyme does this thing, but we don't know how it does it.
Right.
One of the examples that they give is, say, today we use a significant amount of energy to make ammonia for fertilizer. And we do it at high temperatures. And now we're trying to get people not to use fertilizer because we think it's bad for the environment. Well, there's another molecule which fixes nitrogen into the soil, and that's nitrogenase. And that's, what the bacteria does in the soil. And nitrogenases, we don't know how it does it. With a quantum computer, we'll know precisely how nitrogenase works, and then we can start designing other enzymes that can do the same thing the nitrogenase does. And this is at ambient temperature. It doesn't require high temperature and pressure and energy to make fertilizer the way we do it today. And then we might be able to come up with a better way of fertilizing the soil that saves, maybe 5% of the world's energy. And that would just be one thing to solve. The next thing would be in medicine. Today we have only a 10% success rate of drugs at phase 1 getting all the way to market.
Right.
90% failure rate.
Right.
And these drugs, it's $1.5 to $2 billion spent average on a drug in development with and most of them fail. Well, with a quantum computer, you can model that molecule precisely. And so you'll be able to know right from the get-go, will this be toxic? You'll be able to model that. You'll be able to model if it's effective. We think in the future, and this will take time, I got the FDA to use it, but we will be able to use quantum computers to do the phase 3 drug trials. We will not need to use humans as guinea pigs. And so we think you can take that 10% number up to 90%, 100%. You could shorten the time from 12 years to market to maybe a couple of years to market. And you don't have to use humans as guinea pigs in double-blind trials because you will have enough compute power to model exactly how a drug molecule behaves in the body. And so we think this will be a tremendous boon to society. It's difficult to quantify, but here's another way to look at it. It took Moderna 3 days to come up with their vaccine for COVID, but it took us a year to trial it using humans as guinea pigs. Right. And what was the cost of it taking a year? Well, how much did we spend fighting COVID? 20 trillion, 30 trillion globally. The debt we've accumulated, we're going to be paying off for generations. If we had a fully working quantum computer that could simulate how that vaccine worked in the body, we could say, all right, we could prove it's safe, and maybe we could have distributed the Moderna vaccine and the Pfizer vaccine in a month instead of a year, and that would have had economic impact in the tens of trillions. So that's the cost of not having a quantum computer. That's how big it is. So we think in the future, it's going to be a very big benefit to society, and could produce perhaps the world's first $10 trillion market cap company.
Mark, what inning are we in with the use of quantum computing today?
Oh, we're not even. People are still getting into the stands. The game hasn't started.
Wow.
Because today, to make this 100 logical qubit machine, you need 1 million physical qubits. Because you're doing so many calculations, you have to have a very, 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 very low error rate. So you need 10,000 physical qubits to make 1 logical qubit. And so today, there's a bunch of people getting into the 100 physical qubit range, but that they need to get to 1 million. And so if you look at a lot of people's roadmaps, like Rigetti, IBM, Google, it's like beyond 2030 before you have 1 million qubit machine. And we think there's a couple of startups that might be able to get there around 2025, 2026. So we think that those will be the companies that you're going to want to invest in when they come public.
So I was going to just ask you next, right? So out of general AI, augmented reality, and quantum computing, are there any public companies today that are listed on the exchange that you would be an investor in to cover those three areas?
Let's see. In those three areas particularly, there is nothing that I would invest in right now. Now, in the robotics area, there's a couple of companies that have come public that are looking interesting to us. I would put Symbotic in there, AutoStore, and Berkshire Gray. They're all in warehouse automation. They're all being deployed by real companies, and they have real revenues. General AI is, we don't think the public companies are, there's a lot of very interesting stuff coming out of Google, both on the West Coast and DeepMind in the UK, and they're making some very interesting advancements. But I think the technology needed to get to general AI, we think it's you need new types of AI software companies and new types of AI hardware companies that have yet to come public. And so we're spending time on the private side there to learn who those companies are, and we don't believe it's a foregone conclusion that companies like NVIDIA are going to continue to dominate AI. We think they've dominated this first wave of AI. Ultimately, we believe AI is going to be much more like the AI hardware is going to be more like your brain's hardware. Your brain is analog, and when you think about it, Google has half football-sized data centers trying to train models for Waymo cars to drive the streets of San Francisco, but yet your 25-watt brain outperforms them, and it's because there's something about how our brain is architected that's very different than how neural nets are architected, and that's why with a far less electricity, we're able to be a lot smarter than a lot of AI is when they have entire data centers working on the problem. So I think that really is that's the opportunity for startups to come out and with technologies that get AI closer to how the human brain is architected, and those will be the companies that really get us on the path to general AI. And we don't think that the current digital AI chips from NVIDIA and the current neural net companies are on that path. That could change, but we like the startups here better.
So as an investor, right, you have this thought process of where you see the future with quantum computing and AI, everything we just talked about, right? So you make a particular investment on the private side, maybe someone on the public side, right? Which you're not really too optimistic that many companies are really on the public side that are large or ready for that. But when you make these investments, Mark, in these particular companies, isn't it speculation based on what you perceive is going to happen 5 and 10 years from now versus, hey, Mark, let's invest in this real estate property across the street. It's a $5 million property. It's going to give us cash flow of 7, 8, 9%. Or let's buy McDonald's today. It's going to give us cash flow of 4%. Or, Warren Buffett bought in 2018, Apple. And at that time, the cash flow was free cash flow was 8.5% yield versus your style of investing is more based on speculation of where you think things are going to go with these particular areas, which you're probably going to be right. But so how do you, people who are listening, right? Growth investor, emerging technology, value investor here, more predictability, stability, right? Am I right about what I'm saying in terms of the speculation? How do you view value investors relative to what you're doing?
Well, I would say it depends where you enter on the spectrum over time. So if you're Series A investing in a company pre-revenue, yes, it's a lot of speculation. And but as a private company moves along, they do their Series B round, C round, D round. Well, around the Series C and Series D financings, the companies may have revenue, and their product may have a 10, 20, 30x price performance improvement versus some existing technology. You can validate it by talking to customers. You can get a sense of their barrier to entry, the amount of patents around what they have, or just the know-how, who the management team is. I know a great example is this company Snowflake, which is now
Great example.
is public. And Snowflake has this next gen database technology. They are competing with the databases that Amazon has in their cloud, Google in their cloud, Microsoft in their cloud. And so this company is somehow managing, well, they're using those companies' cloud services to host their stuff. And then they sell their database on top of that, and they're able to beat the incumbents who have the ability to bundle, right? They have the ability to probably sell their database combined with the cloud services at a much lower combined price. And yet somehow Snowflake keeps acquiring all these, global 2000 companies, and are growing revenues 100% a year. And then you look at the management team. So the management team at Snowflake was the same management team that took Data Domain public, and then it got acquired in 2009 in a bidding war, which almost never happens in tech, between Network Appliance and EMC. Then that same management team went and built up ServiceNow they really set it on the path to become the big SaaS franchise that it is today. And now that same management team is at Snowflake. And so, now I would say, Snowflake is, it's not so much looking, you don't have to wait till it's an 8% free cash yield. Warren Buffett did well getting into Apple in 2018, but he would have done much better if he acquired Apple when the iPhone came out, and realizing, wow, this thing is so different from what BlackBerry has and Nokia has. This could in fact take over the entire mobile phone market. He would have made more money if he'd done it then. So we think it's it all depends when you enter. And if you enter in the public markets, you will most likely be investing in companies where they've established a product that's very differentiated. And if you like the management team and you understand the size of the market opportunity, you can get into these companies and do very well. And it's not as speculative as you would think.
So what are the top 3 things that you've learned that's really value added and help you make money with any particular investments you had? You just mentioned before a few things, but I just want to see the top 2 or 3 things that comes out that helped you get it right with a particular investment.
I think, I think it's understanding. You have to understand the technology and what it can do and the market opportunity. You really want a great management team, and lastly, you do have to focus on entry valuation. And the idea, you'll hear this at every market top: valuation doesn't matter. And by the way, this is from an optimist in technology. If you hear that, you really got to run in the other direction, because valuation does matter. And there's times when things trade at 50 times or 70 times, not this year's revenue or next year's revenue, but the year after that revenue, that's too high. Because ultimately what will happen is, like, look at the multiples today on Google and Apple, and these guys have relatively modest multiples on free cash flow and relatively modest. So anything that's 50 or 70 times sales today eventually has to get down to 10 times sales, 8 times sales. So you've already, from 50 down to 8, right? You've already baked in the first two doubles in revenue just to get the multiple to a normal place. So to me, what you really want to try to do is minimize the multiple contraction you have to suffer through. So yeah, if you can get into something at 20 times sales, that's going to go to 10. Right, the first double in revenue, you're not going to get the credit for it. But every double of revenue after that is going to lead to a doubling in the stock price. So if you can find a company that can over 10x revenues, but its multiple may be cut in half over a 10-year period,
Right.
you can make 5 times your money and get a great return. But if your multiple needs to come down by 80%, well, yeah, then you need to 4 or 5x your revenues, and your stock may not go anywhere. So it's really not that hard to think about. But some people, some of my peers in the business, sometimes say valuation doesn't matter, and that's that we think is poor discipline. Valuation does matter, and it's better to enter things. Things like Snowflake. There's multiple times it was like at $380, $390.
Right.
And when it gets down to 114, 150, that's just a better entry point than $380. When it was $380, all the sell side had buys on it. It's just like, and now down here they cut their targets. A lot of them go to neutrals.
Now's the time to buy.
Yeah, it's so now again, I understand
Same
why they
story.
do it. Yeah, well, you don't want to tell all your clients that they're wrong that are buying it up there at 380. So there's a little bit of a kabuki dance that goes on there, but you just have to be smart, saying it's a great company. But look, when a startup with $1 billion in revenues is worth more than $100 billion in dollars, how much money can you really make? I mean, if by the way, as an entry point, you get in 150 billion. If it goes to $1 trillion, I only make 6 times my money. It's maybe it will go to $1 trillion, but if it gets to $1 trillion, I want to be making more than 6x on it. And so you wait, and you almost invariably, even the best companies, when the multiples get that extreme, they will come in. So just have some common sense on multiples. It's not that hard. It has to pass a sniff test. 50 times, 70 times sales, it's probably too much.
I think so. And some of these are still trading at those levels. So how does someone like you get into this emerging technology growth type investing versus others who get into more value investing? In your opinion, how does one become one versus the other? How did you become this emerging tech growth investor, which there's a lot of volatility, versus a value investor?
Well, I think I go back to like that analysis of the top 10 market cap companies, or actually you look at any big fortune that's been made, it's usually on like a disruptive technology. When you look back at the old money, back at in the Gilded Age, 1920s, right? It was people that made steel, right? Like knowing how to make steel. It was Carnegie, like they made a lot of money understanding that technology. The people that built railroads, et cetera. And so there's always the new wealth is created by these new technologies. So to me, I actually see myself as I think like a value investor. To something I'm trying to figure out what that future big industry is, and because that's where the new wealth will be created, and so that's why we're shifting away. Like we don't we liked mobile computing, we liked social. We were in pre-IPO and Facebook, LinkedIn, and Twitter. We made Facebook and LinkedIn cores when they came public. So there was a time to invest in that. But now we're looking at these next ones, and we look at what the technology can do. If a technology like general AI can enable today, like the robotic business, it's in the tens of billions, right, of robotic arms.
Right.
Most of them going into the auto industry. But what we don't have is, robots walking around, or, robots that can build a house, right? You have humans, humans hammering a nail. It's a simple thing, but understanding a house and blueprints and, how to move around with the other workers, it's such a complicated thing. So, self-driving cars, long before we have robots that can assemble a home. But one day we will, when we solve that general AI problem, and then we might have billions of robots building stuff for us, and it will be a world that will be very different than today. We'll have, productivity growth at maybe 2-3% a year instead of 1.5% a year, and we'll have, an economy that's tens of trillions of dollars larger than it would have been otherwise. Had we not had those technologies. And so when you look at that potential, you could go in and find, well, what will we need to make that happen, right? We'll need, we can't put a data center inside of a robot that walks around building a house. What we'll need is analog chips that resemble the human brain, so we can have something that's got the same amount of compute power as the human brain, but only consumes a very little bit of power. Well, there's 3-4 startups that are serious in that area, and we're watching them now. And we're going to see who emerges from that between now and when they go public. And when they do go public, then it's like there was a bunch of companies trying to do it. It's filtered down to a couple of ones. They have their patents, they got their design wins, and then we'll know which one to make a core public company. And then, because that'll be an enabler to taking the robotics industry from tens of billions, 20-30 billion a year, to maybe a robotics market that's $1 trillion a year in terms of actual revenue. And so those things are out there in the future. And now it's just about figuring out who the small. It's not going to be 100 companies. It's going to be a small number of companies that are the key enablers to that big future market. Just the same way it was basically Intel and Microsoft that made the PC thing happen.
Right.
I think we're going to have the same situation here. It's going to be a handful of companies that are going to enable this big new revolution in robotics. And by the way, that's the endpoint robotics. Between now and then, you're going to have a lot of very specialized robotics companies that use the older neural network AI, but we're already seeing these things. Like this company Symbotic, it was a SPAC, which, SPACs all have their issues, but this one has $150 million investment from Walmart, and Walmart's all 42 of their big distribution centers are going to be putting in these $50 million systems from Symbotic to automate big pieces of all Walmart's warehouses. And not the warehouse. There are 42 big distribution centers, and so that's not a general AI company, but it's a robotics company, and they got I think $5 to $10 billion of backlog, and it's not just Walmart. It's a bunch of other retailers as well, and those things are happening now. And so so that's the other thing too. You don't have to wait for the endpoint. You don't say, well, I'm not going to invest into robotics until general AI is solved. You can start investing in robotics now, because there's very, the warehouse robotics may not be $1 trillion opportunity, but who cares if it's a 50 billion a year, $100 billion a year opportunity? That's still really good. That's as big as the database. One of the largest markets in software is the database market. You can have a robotics niche that's the same size as the database market. That's pretty damn good. So there's going to be a lot of opportunities like that in the near term. And then, eventually, maybe 7-8 years from now, someone's going to solve the general AI problem. And then, that will be, that's the one that's going to get to $1 trillion. But in the meantime, we'll have opportunities to buy in companies at $5 billion market caps or $1 billion market caps that have a pathway to 50, 100 billion that you can make a lot of money on without necessarily, you don't just have to think of it as there's going to be 10 future top 10 market cap companies, and that's the only 10 I can invest in. That is, it's more complex than that. There'll be a lot of other companies that you can invest in along the way and make a lot of money.
Well, Mark, you mentioned it before, this is my last question for you, is the productivity can go to 2 to 3% versus 1 to 1.5% now. Technology that we had that was revolutionary for our country, that, you know, from 2000 and going forward, was all technology that helped us in the back office.
Yeah.
But we're talking about technology now that can help us almost on the front lines, right? Could you explain that to us, what you mean by that?
Well, it's the way I look at it is that it was in a lot of ways, a lot of the technology today is back office, right? Like, you know, when you do a Google search, that's in a data center. Cloud computing is a lot of a back office things. And in terms of, like, you know, you could say like SAP was the back office and Salesforce.com did front office. But what I would, I'm saying that what the data shows, and it's surprising, right? When we in the late 90s and early 2000s, productivity growth is actually better than it is now. And so going from, you know, not having PCs to getting PCs and internet and client server applications for the first time was actually a bigger boost to productivity than going to cloud computing and mobile computing. Now, I have my theory on that, which is, well, cloud computing and all this stuff, it's all very good stuff. But, you know what, mobile computing can be a very big distraction. I joke with investors sometimes that I hold up my iPhone and I call it WMD, a weapon of mass distraction, because I can watch TikTok videos really all day. Good. I can watch YouTube on it. I'm texting my friends all the time, and so I like it for my life. It's very entertaining, but yes, it can increase my productivity because I can do Zooms in a taxi. That's a productivity boosting thing, but it can also distract and take away. And I think net social media, I don't think there's anything productive from social media. I think it's probably a net negative on productivity. But
except for sales, right?
Yeah,
I mean, except for sales, right? I mean, it was good for advertising and.
Yeah, it maybe it increases advertising efficiency, but it's also, I mean, it's leading to big increases in depression and mental health issues, and these things are taxes on the economy. So it's not clear to me that all this stuff is so great. That's why we get so excited about the new stuff. General AI that'll enable this big robotics revolution. That's hard. That's not soft ROI. That's hard ROI. Quantum computing will affect every sector of the economy. If genetic and proteomic engineering, if we can get molecules made from yeast and bacteria that's cheaper and cleaner than getting it from fossil fuels, that's just huge for the economy. So so what we like about these new technologies is that we think these next megatrends impact all sectors of the economy and will bring productivity boost to all of them. They're hard ROI things, and it's not the stuff we have today is a little hand wavy. And if you look back at the post-war prosperity, you look at the productivity growth rate in the 40s, 50s, and 60s.
Right.
We were doing around 2.5% a year. Going from no superhighway system to superhighways, no telephone to telephone, no electric grid to electric grid. That stuff was much more impactful than Google and smartphones and Amazon. And so we think we're living in this Dick Tracy future world, but it's when you look at the actual productivity numbers, they're not that great. And you always know what I always love is the productivity numbers aren't that great. And then people say, oh, well, we're just measuring productivity wrong. It's like, that's the clearest sign that we're probably measuring productivity right. It's just the technologies weren't as great as we thought they were. And so that's why we're very excited about these next technologies, because these will actually deliver that big sustained productivity growth which quite frankly we need, right? We more than doubled debt to GDP globally since the 1980s. So that's a big debt burden to carry. And what you really want to do is, instead of trying to inflate your way out of it, or convert debt into equity through a painful process, what you really want to do is economically grow out of that debt through increased productivity. And I think these megatrends will be the exact thing we need to do that. So I think it's not just a way to make money. I think it's important to bring prosperity forward for all the world.
Before I let you go, in the emerging technology world, number one publicly traded company that you would invest in today?
Oh, that's Willie. I'm going to give a little bit. There's ones I believe that have more upside, but in terms of a combination of a good valuation now, great management team, very large market, I would put Snowflake. I think Snowflake is now yet it's a 50-60 billion dollar market cap company. So I think it can get beyond Salesforce's market cap, and it can get to I think there's a definite pathway to 500 billion. So I think you can buy it, and it's a 10 bagger. And so I think it's just a great it's a great management team, but it's not something that you can't buy it at 50 billion and make 100 times your money. So, but in terms of a safe company, it's a company that can really get up there in big market cap. I think that's one of them.
I agree.
So I feel very safe on that one.
I agree with you. Marc, this has been amazing. Really is. Your perspectives are amazing. It's I look forward to working with you. One of the things that that we really get involved in high flying technology stuff, but now that it's really come down here, we're looking to bring you on as a firm to help us navigate that area and be in the right emerging technology. So look forward to working together with that. This is really fantastic. So thank you so much for your time today. Really appreciate it.
Well, I really appreciate you giving me the opportunity to speak, and look forward to working with you.
Likewise, likewise.